we're in one of the most overvalued markets in history, but also we are in one of the strongest markets in history. And while everyone is out there celebrating, I cannot help but wonder, are we headed towards another massive bull run, or are we staring down the barrel of a bear market and a potential crash? Today, I'm breaking down the hard data, why we may be in the middle of a bubble, and how you can prepare for any market outcome, no matter what happens. For the bulls out there, the people think that this thing is the start of a long-term bull market. Here's a great thing. You have a 72% chance of making money in stocks in 2025, and why it's short-sighted to bet against the market in 2025 or any year. Now, obviously, that's true. The market over time does go up, and any year is more likely to be up than down. But we're also at valuation levels that haven't been seen in a very long time. Here's some more good news for you bulls out there. We've come off of 13.4% annualized returns. The interesting part is, following 10-year periods in which the market rose, the odds of the market rising the subsequent calendar year are 73%. The same at any given time. It doesn't matter if the market is up or down. In fact, look at this. The bottom line is, based only on how the stock market performed this year, the odds of stocks rising in 2025 are no higher or lower than they would be if equities were sitting on a big year-to-date loss. That's incredible data. And again, for the bulls out there, this is wonderful. The bears, it might seem scary. However, for the bears, and by the way, bears doesn't mean that they're always bearish. A true market valuation person will sit there and say, I make my decisions on where the market stands based on where valuations are at any given point. Just like myself. You guys don't know me from 08 and 9. But I was a huge bull market enthusiast. Bank of America, Merrill Lynch, Bank of US Trust would always call me and say, you're the only good phone call we get. Because I sat there and said, guys, why do people love stocks more when they're up versus down? It makes no sense. To repeat this point, the market's odds of rising in any given year are 73%. Following calendar years in which stocks rose, those odds are statistically indistinguishable, 72%. Incredible. I would have not believed this had I not seen this. And it's from a very reputable website, MarketWatch, and Mark Huber. I look at this going, wow, incredible data. So the question is, are we in a bubble? Well, remember, every bubble follows the same stages. It starts with a very sound idea. The sound idea here is stocks are great for the long run. Artificial intelligence is a game changer. Electric vehicles are a game changer. Legalization of cannabis is a game changer. Everyone should own real estate. Do you get my point? It sounds like a great idea, something revolutionary that grabs attention. Then comes FOMO, the fear of missing out, media hype, skyrocketing prices, everyday people jumping in to fuel the frenzy. We've seen it all before, especially lately in the world of crypto. The idea of crypto is a wonderful idea. I buy into it. Deregulation, not being able to track things, but we're also living in the internet age. In fact, I'm now starting to see articles talk about how with the new computing power from Google, it's just a matter of time before the blockchain and crypto with Bitcoin can be hacked. Guys, this is supposed to be the unhackable. After this comes the mania phase. That's where prices completely disconnect from reality. And finally, the bubble bursts. Price collapse, people panic, and usually prices go well below normal valuation levels. Guys, look around. AI stocks are dominating the news. Speculative plays are back in fashion, and valuations are through the roof. So guys, the two market valuation metrics I always look at is stock market to GDP and the 10-year cyclically adjusted PE ratio. What that means in the cyclically adjusted PE ratio is it takes the last 10 years of earnings, applies inflation to bring it in today's dollars, and divides the market cap of the S&P by that. Currently in the stock market GDP ratio, we are 115% overvalued. 115% overvalued. Just to go and show you how bad that is, going back to 1929, looking at quarterly numbers, we've had 36 quarters where valuations were 40% or more overvalued. We're 115%. And in those, the next 10 years averaged a negative 0.2% return, not including dividends. And guys, we're almost triple that level. Almost triple. Think about that. Now, for the cyclically adjusted PE ratio, we're currently 117% overvalued. We're currently sitting at 37.36 versus a historical 17.17. Any way you cut it, whether it's complete market cap relative to the entire US economy or the 10-year earnings in the S&P, we are so incredibly overvalued. And guys, this is the S&P 500 earnings by year. The peak was the year of 2021, and we're now 10% below that number. And we're actually, as of June 30th, 2024, a little bit below all of 2023. So I look at this thinking to myself, geez, oh, Pete, we're not making a ton more money. Look at stocks. All of 2021, how much higher we are than we were back in 2021 today, yet earnings are down. That's a dangerous setup. But let me hit you with one more warning sign, the yield curve inversion. Right now, the yield on a 2-year treasury is 4.34%, which is higher than the 10-year at 3.78, a signal that has predicted every recession since World War II. I put on Twitter. I went out there. By the way, I'm at EMPaulG on Twitter if you want to follow me. I love to put polls out to engage. Did we have our first soft landing ever? Yes, was 25.95%. No, it's not over yet, was 74%. Now, guys, for our principle-driven investing, what we want to do is focus on price versus value, not where the market is. I'm the kind of person who made mistakes. The mistakes I've made in the last few years have been when I sat there and didn't buy stocks that I thought markets were overvalued. Big mistake. A great company at a great price should be bought even after it falls, because remember, we look at every investment as the present value of all future cash flow, and if the stock price goes down and the fundamentals are still good, we continue to buy. So what is causing the yield curve inversion? Well, what it's saying is people are more fearful over the next 2 years than over the next 10 years, which means they fear something happening in the short run. Investors are piling into longer-term bonds seeking safety. An inverted yield curve may be different right now, but typically is a flashing red light for the economy. And combine that with sky-high valuations, it paints a picture of a market that could be ripe for a major correction or crash. The historical VIX has been at 19, and the last week we had a lot of ups and downs in the market, and the VIX skyrocketed one day after the Fed announced their position. The market was up and then drastically fell almost 4% for the day. And when the fear is low, it takes a small catalyst to trigger a crash. Think of it like a room of gasoline. A spark will cause the explosion, but we don't know what spark that will be. Now, obviously, Warren Buffett is a guy that everybody admires in this world from an investing standpoint, the best investor of all time. And this guy is sitting on almost $350 billion in cash, which makes up 56% of Berkshire's portfolio and 35% of its entire market cap. Now, what does that mean? Well, he can be more cautious. He can stand on the sidelines. He goes in and out of stocks like he never said before. But why would the guy who believes so much in the U.S. economy be sitting on the sidelines with so much cash, especially with all these multi-trillion-dollar companies he could invest in? He could deploy that cash very easily and not put a dent in the Mag 7. He doesn't see value there. He always says he wants to keep a significant cash position that he's ready to buy when the market presents opportunities. In 2008, he deployed a ton of cash to support banks and get some really good returns. But lately, he's been reducing his positions in Apple, Bank of America, and Chevron, while piling into short-term treasuries, earning over $20 billion annually in interest. So what does this mean for you? Maybe Buffett's timing the market, maybe he's not. He's staying patient, disciplined, and ready to act when opportunities arise. And that's exactly what I want you to do. But you don't have billions of dollars. You need to stay active in the market. But do that by dollar cost averaging into low cost ETFs. Don't pick individual stocks. That's too hard of a game to play right now. And valuations are so high right now, it's kind of hard to do that. So what happens if it's a bull market in 2025? Well, we'd be a continuation of this year's bull market. Investors are confident, earnings look solid, maybe they can rebound from previous high, and everything seems rosy. This is what we've been seeing for the last 2 years. If this trend continues in 2025, stick to your process. Don't get swept up in the hype. Dollar cost average into low cost ETFs. And if you buy individual companies with money above and beyond what you need to hit your goals, focus on buying great businesses at great prices. Now, those great prices are very subjective, but the key is that when you buy a stock, it's very unlikely that you never see a price lower. You probably will. So make sure you understand that the market dictating a price doesn't mean the stock's actually worth that. If the fundamentals are getting better and the stock price goes lower, you need to be able to stomach the ability to buy more stock. Dollar cost averaging will always work in terms of matching the market. Stick to that while you sit there and put the money you need in for retirement. Only buy individual stocks when you feel so comfortable with your process and you have excess cash to be able to deploy in that. Avoid overexposure. Don't bet on the farm on hot sectors like AI or crypto. Stay diversified, stay disciplined. Guys, it's easy to make money in a bull market, but it's just as easy to lose it when the party ends. And everybody out there thinks they'll be the first one through the exit when somebody yells fire. That doesn't happen. I've always said, I think Tesla and Bitcoin will be the poster children of this bull market. We'll see what ends up happening with it, because now we're talking about Bitcoin and reserve currency and all these things that are absolutely blowing my mind. But who knows? So what you should do if the market is a bear market in 2025? Now remember, a bear market is the exact opposite of a bull market, but we usually need a 20% decline from the peak to trigger the typical definition of a bear market. If 2025 turns into a bear market like 2022, it's not the end of the world. In fact, it could be one of the best opportunities you'll ever see as an investor. Every past bear market and crash looks like an opportunity. Every future one looks like a risk. If stocks fall, this is where real investors shine. If you need a bull market to make money, you're not an investor. So here's how to handle it. 1, stay calm. The worst thing you do is panic sell when prices drop. Number 2, keep dollar cost averaging. If you have individual companies, be ready to jump on them and buy more and root for it so you can buy more of a great company at a better price. Falling prices mean you're buying more shares at cheaper prices. This sets you up for massive long-term gains. Look for bargains. In a bear market, high-quality companies often get unfairly punished because people are unilaterally selling. If they're selling ETFs, those ETFs have to sell everything. That's your chance to buy them at a discount. And remember, bear markets are where wealth is built. Buffett didn't become one of the richest men in the world by chasing trends. He built his fortune by buying undervalued companies during every market, but especially during downturn. Imagine waking up in 2025 to see the stock market in free fall, your portfolio down 40, 50, maybe even 60%. Most investors would panic, but this is the opportunity of your lifetime. Now, a very common question we get on every live stream, every chat in our community is, should I wait for the market to crash before I invest? And the answer is a very hard no. Look at this chart from JP Morgan. If you invested $10,000 in the S&P 500 from 2003 to 2022, it would have turned into $65,000. But if you missed the 10 best days, your returns would have been cut in half. Something I always bring up also. QQQ, the NASDAQ 100. If you bought it on the very peak of 2000, where it then began to fall 83% and took 16 or 17 years to get back to even, if you had just invested then and dollar cost average it from there, you would have made almost 15% return on your money after falling 83%. Timing the market doesn't work. What does work is staying consistent. Dollar cost averaging the ETFs and individual stocks that you understand will always do better than trying to outsmart the market. So guys, whether 2025 brings a bull market, a bear market, or both, the key is to have a plan. The market is overvalued. Risks are real. People probably are not factoring in those risks, but every future potential crash isn't a reason to panic, it's an opportunity. In the Everything Money community, we don't just survive downturns, we embrace them. When the market is down, the activity is so exciting, people are cheering. Our members love when stocks fall because they understand that's when the real opportunities to build wealth are created. We are principle-driven investors, and when the market falls, we focus on doing the right things, staying calm, analyzing value, and making smart decisions. So if you're interested in having that outlook, if you're interested in being a more of a principle-driven investor, join our community. $7 for 7 days. You'll get access to our tools like Stock Analyzer, and more importantly, you'll become part of a community that thrives in any market. So click on the link in the description below to sign up today. Thank you for your time.